If there was ever any doubt which markets mattered most to policymakers and to global economies, we know now for certain it is not the stock market. It is in fact the bond market, which has been showing signs of extreme stress bordering on breaking recently, which is why you need to watch out for the Federal Reserve bailing out the bond market at some point very soon. Jamie Dimon, the CEO of Chase, recently said that he expects a kerfuffle in the US Treasury market that will prompt a Federal Reserve intervention. Now, a kerfuffle in this case means the entire bond market breaking, liquidity seizing up, and somebody big about to go bust, go out of business. Something like Lehman Brothers. That's what Dimon means by kerfuffle here. He doesn't simply mean, oh, the 10-year goes up a little bit and government financing gets a little bit too expensive. Kerfuffle means something catastrophic that, if it's not dealt with, could take down the global financial system. Otherwise, that would not prompt a Federal Reserve intervention. He goes on to say here that the expected turmoil is because of all the rules and regulations, and that he believes the Federal Reserve will only step in when they start to panic a little bit. Again, this is not going to be something from Treasury prices falling a little bit. This is going to be something catastrophic, something along the lines of September of 2019. You remember when the Federal Reserve had been allowing their balance sheet to decline, and then suddenly they reversed course and called it not QT. Well, what has the Federal Reserve been doing recently? They've been allowing their balance sheet to decline. When the Federal Reserve's balance sheet goes up, that's called QE. They're injecting liquidity. The opposite is true as well. When the balance sheet goes down, they're withdrawing liquidity. This is one of the many factors that has contributed to interest rates on government debt going from so low to so high over the last couple of years. And the lack of liquidity in the system is starting to show through, with cracks forming, evidenced by the 10-year yield moving from 3.88% all the way up to 4.58% in the matter of days.